I'm Sidhartha or Sid Dash from Chartis Research. Today we're going to discuss ALM and liquidity risk in a changing landscape, the key challenges, the tools, the technologies, and the potential metrics and options. For that, I have two really distinguished panelists with me, and I will have them introduce themselves. Christiana, could you please introduce yourself?
Yes, good morning to everyone. I'm the head of ALM team at Banco BPM, that is the third bank in Italy. I'm responsible for managing IRBB at a group level. I started my career as a foreign exchange dealer, then I was appointed head of treasury, risk manager, and then head of ALM at Banca Monte dei Paschi di Siena, and then I moved to Banco Popolare that merged with the BPM, and now we have the new Banco BPM group where I am the head of ALM. Graduated in economics. I hold the FRM, that is Financial Risk Manager, and Professional Risk Manager certification. And I'm also co-head of the Asian Forex ALM Commission in Italy and member of the EBF IRBB working group.
Thank you. And Gerwin?
Thank you very much, Sid. Yeah, I'm Gerwin Sharman. I'm actually the head of treasury of Santander, Germany. And well, in the last 25 years being involved in financial, more or less engineering financial business, I worked in different areas in banking, derivatives, securitization, debt capital markets, credit risk management, portfolio management. And last but not least, I came over to treasury. Well, before I joined Santander Consumer Bank in 2014, I spent 13 years in London, most recently working there as a managing director in Treasury in RBS. And before that, I was actually in debt capital markets in ABN AMRO, where I was strongly involved in the securitization market. But after the financial crisis, I loved the Treasury most because the music was playing in Treasury rather in that area I was involved before. So therefore, I still love Treasury and I continue to be there.
Great. So with that, as you can see, I can't think of two more qualified guests to talk about liquidity risk, liquidity metrics, impact of interest rate risk in ALM, and the dynamics thereof. So with that, I will immediately dive in. And my first question is to Christiana. Christiana, what do you think overall about the challenges of liquidity risk and the overall liquidity risk metrics, both from a banking perspective and overall systemic perspectives?
Thanks a lot. As a premise, I would like to say that I'm more on the IRBB side than on the liquidity side, but I'll try to give a more general picture. I would say the global financial crisis in 2008 was followed by a Eurozone crisis in 2011-12, and followed by COVID. We had three big crises coming in rapid succession. And in a way, we've almost forgotten what normal looks like. So after the crisis, the three crises, we have a massive response from central banks. And after a pandemic, even a coordinated response from monetary policy and fiscal policy institutions. So investor has just sort of been spoiled for like 2 decades by low interest rate and negative interest rates. And I remember we were discussing how to deal with negative interest rates and also non-conventional monetary policies such as collateral expansion, TLTROs, and so on. So now it's over. Inflation is here for the first time in most investor living memories, and it's here to stay because we have we were taught at the very first, let's say, stages of inflation that it was temporary, and now it's not so temporary. And a decade of easy money policy gave some incentive to take greater risk. And so central banks, as we know, have two important goals. One of them is set monetary policy and control inflation, but the other is protect financial stability. And where rates go down, these two goals have worked pretty close and pretty well. But if you had no inflation and low interest rate, it's easy to rise to the rescue of financial stability grounds without compromising your monetary policy. And I would say saving banks, saving institution, and easing could require somewhat the same action. But with high inflation, your financial stability function no longer pushes in the same direction as monetary policy. So we've seen it with the UK pension fund crisis, the SVB crisis, and other medium institution in March 2023, and also with Credit Suisse. So central banks need to step back from the tightening stance to promote financial stability and then turn back to tightening mode. But they have done it pretty well. They act promptly and they have quickly regained market confidence, I would say. So about ECB, I would say also that ECB was better in preventing the crisis due to greater diffusion of supervision based on the tools that came out of Basel after the financial crisis. So, namely LCR, NSFR, and also, let's say, my cup of tea, that is the SOT on IRBB. So there was limits, there was thresholds that were preventing an excessive risk taking on IRBB and on liquidity risk. I do think that LCR and SFR may be better, or they can be imperfect tools, but they probably were useful in preventing the crisis.
So in many ways, in your perspective, the liquidity measures affected so far have been imperfect tools, but perhaps they're better than otherwise, and regulations have been somewhat effective, if you will, but the central banks need to think hard, or harder than they used to, because their constraints have become tighter. Gerwin, what about your perspectives on this?
Yeah, I think Cristiano has actually really done a perfect introduction in the changing landscape. And from a treasury perspective, yeah, it was a very boring landscape because everybody thought the liquidity is coming from the central banks. So why do I need a treasurer at all? Now actually things have changed a lot. The money is not coming from central banks anymore. It's coming out of the market and from retail customers. And as such, yeah, the music is playing again in treasury. And from my perspective, as I said before, I was involved in the financial crisis when I was working in London. So in the middle of the storm in RBS, and I think it was quite interesting what I have learned there. And before that, I was even working in a German bank which had a local crisis, liquidity crisis. So I'm always actually way focused on liquidity risk, even in days when everything looks quite okay. I look at actually it very carefully, and maybe early warning is most important for liquidity risk, because you have to do pre-funding if you go into it. This is definitely what I've learned from a liquidity crisis. As such, yeah, I totally agree with Cristiano and you that the regulators have introduced, well, I think the FSA was the first with coming up with something like LCR and NSFR in the UK with their learning lessons they had in the financial crisis. And yeah, from a regulatory ratio, I actually focus most on the NSFR. Well, it depends actually very much how you are funded. The LCR is less important maybe than the NSFR, so it depends a little bit on where you are at the moment. But LCR, I look actually not on the 30 days, I look actually at the longer LCR, if I look at that. And therefore you will understand that from an economic regulation or economic perspective, I look very much at liquidity horizon under stress, or liquidity buffer, which is then in line with the longer LCR. So these are the two aspects I focus most on. And yeah, there should be something like an early warning if my funding structure is actually helping me to overcome potential liquidity risk, or do I have to do more? Do I have to do more pre-funding in certain areas to be more stable and increase my liquidity horizon under stress? So that is actually my perspective, very much learning out of the financial crisis, which has influenced me a lot.
And how do you see with the resurgence of interest rate volatility, what do you think are the key challenges and institutions are facing now in managing market-based and funding risks, if you will?
To me or to Cristiano?
Oh, that's a question to you, actually. It's a follow-up.
Me. Okay. Yeah, I think the change in the interest rate environment changed a lot the steering of liquidity. As I've said, the music is playing again in Treasury, and before it was not. I think the last 10 years, I got maybe as many questions on interest rates as I actually got in the last year, in the last half year, actually. So there's more interest in the entire bank about what's going on because everybody's feeling there's something going on. It's interesting, it's important, and it has something to do with liquidity risk. And well, for my customer-facing colleagues, well, maybe they don't care so much about liquidity risk, but they care about funding and funding pricing and how they can actually provide the funds to their customer, which has something to do with liquidity risk again. So therefore, yeah, I think we are in a totally different environment. But on the other hand, I think we are back to the textbook analysis we all have learned in the university that actually you have, for example, positive liability spreads on deposits. Well, which you didn't have actually a couple of years ago. It was all actually deposit was not good at all. Yeah, it was costly, and therefore they have introduced negative interest rates or penalty rates for our retail customer. Well, we are back actually to normal in a way, but we have been back in such speed that actually all the models we have are well getting under stress, or the back testing we have done in the past was not real back testing because there was no volatility. Now we see that actually the models have to be recalibrated in a way. And I think that's quite interesting. And I do believe that the liquidity stress testing have helped me to be early in looking at it and addressing things. But I think the interest rate environment, and then Cristiano is much better maybe to talk about it, is about actually recalibrating the models, figuring out what is the outflows of the different asset classes and how does it all work, and how do I have to hedge my portfolio to be actually a little bit stable in my P&L.
Of course. Sort of dwelling a little bit, given that we are talking about interest rate and its impacts, Cristiano, how do you see this whole, both the rising interest rates, but also the more volatile interest rates and more complex interest rate environment? How does it impact the whole banking book? And I think that goes to the heart of the IRBB and dynamics, etc. So if you just could expand a little bit on that, that would be very useful on your perspectives.
Yes, I would say there's a lot to say here. I would say that on one side, obviously the change in markets and in the market environment. So we had, as we said before, very low or negative interest rates for a decade, and now we've got raising interest rates and also let's say a negative maturity transformation. So for ALM it's for sort of a nightmare because the, let's say, short-term interest rates are higher than the longer-term interest rate. So it's a challenging environment, and it challenges also traditional way of banking because as we said before, the maturity transformation is not working anymore. And on the regulation side, as we said before, we had a very long period of no regulation on interest rates. So we started in 2004 with Basel II, with some principle on the supervision of with BCBS 108, if I remember well, and then a long period of silence by the regulators, probably because 2008 and 2011-12 with the crisis of Eurozone and the great financial crisis, they were, let's say, writing other rules on liquidity, on credit, and so on. And so we've seen something different in 2015 with EBA, and then in 2016 with Basel. Basel was applied in 2 or 3 stages by EBA, and now we are with a very a more complex let's say set of rules, in particular in Europe, because we do not have only the BCBS SOT on EV, that was the older one, on the a sort of, let's say, we do a sort of partial fair value with EVs only with risk-free rates, and on the other side, EBA has added an SOT on NII. So 2 thresholds, one against the other, because when you try to adjust the SOT on EV, you will, let's say, go against the SOT on NII. And so we have a regulatory environment that is becoming quite challenging, also because of more disclosure rules, more reporting rules asking, and a market that is on the other side as challenging as the regulatory environment. So in interest rate risk, there's a lot of work to do, and there's a lot of work for also software, IT, and counseling and so on, because the environment is it's quite challenging, and there is a lot of difference between here and the past, and also I should mention the behavioral modeling that are, let's say, sort of let's say paramount for liquidity and for interest rate, and the behavioral modeling needs to be, let's say, adjusted because of the new environment. We are no more in a very low or negative interest rate environment. We have interest rate rising it's affecting how you have to plan as a bank, and how you have to, let's say, see your liabilities, as Gervin was mentioning, and see and forecast your change in liabilities because of this new environment with very high rates and maturity transformation that is not working.
So it seems that we are in a considerably new modeling environment, and a new sort of, you need to rethink, or at least recalibrate at the very least, the models, the tools, the techniques, and the approaches, and the way of thinking about interest rate risk on a banking book, if you will. Gerwin, would you broadly agree with these this central theme, if you will?
Well, I think definitely. I think yes, laid it out way good, precisely, much better than I could have done it. But I think I have to admit, Cristiano, that we, of course, see this challenge as well. So in the treasury area, I think in one hand, it makes a lot of sense that actually when we have a way volatile interest rate environment, steep sharpening of the interest rate curve, that the regulator is focusing on that, which is fine. But I think they are reducing the flexibility banks will have and the challenges with the different, more or less, NII and EAV. So this is definitely a big challenge where we are just still fighting with the speed of the ECB increase. And I've actually in another speech shown a graph of the different, let's say, interest rate hikes of the ECB compared actually to the US and the Bank of England. And you can see that I think ECB was quite late in starting to increase interest rates, but in comparison to the other hikes, they were way, way fast and way, way steep, which was the biggest challenge, I think, for the banks in the interest rate risk management and for the client areas as well to, follow the elasticity they have put into the models before the crisis. You have to maintain that. You have to increase the client rates in accordance to the elasticity you have put in the models before. And that was definitely a challenge because the client is not actually just saying, well, you follow your elasticity, that's great. No, I think the client, has competitors and they have a different environment. And you have to look at all that. So that was definitely the challenge. And therefore you have to look at all your models. Are they actually really done for this steep increase of interest rates, or was they actually done for a more smooth moving up ladder? And I'm afraid they were maybe designed for the later than for the earlier. And this is actually a challenge, and we all have to look at these models again. And then on top of that, we have to introduce the sort for NI and all other lovely regulations which are coming actually to us. So it's an interesting time which we are currently in.
So I guess potentially looking at the curse of may you live in interesting times. But coming back to another theme, the idea is that, okay, so in this period of change and in this period where I think both of you agree that we need to, the institutions need to recalibrate their models, need to rethink their target and focus. What role would you think technology plays, both from a computational perspective and both traditional computational techniques as new ones, and then similarly from a data management perspective, what role do you think technology would play? To start with, maybe Cristiano, if you'd go first on this one.
Okay, I would say I would start that with let's say the so-called deep tech. That is a term that involves many new technologies such as artificial intelligence, quantum computing, and also biotechnological techniques are probably such invasive innovation that we are destined to change that are destined to change our lives more sooner than later. So I'm particularly struck by the strike to protect workers' rights against the indiscriminate use of artificial intelligence by cinema workers. I think it could happen in other sectors. For example, I recently saw in probably it was the Financial Times that a CEO, I think Citigroup, predicted that 30% of banking jobs could be eliminated by AI in the next 5 years. So and risk compliance could be among the most affected. So we won't, me and Gervin, we won't be here next year to discuss ALM or liquidity. Good luck to the IT guys that you are pricing in the afternoon. They probably will be the only left. But I would say it's a joke. And I would say that AI should not be only about job elimination, but more a tool to increase productivity and happiness in the workplace. So in the field of liquidity, I would say that AI could certainly help to identify what are the best instruments to use to manage liquidity and what are the best scenarios to perform in a liquidity stress test. And it could be very helpful, I would say, in helping what kind of connection there can be between interest rate risk and liquidity risk and also in other fields.
No, absolutely. Most of the new AI techniques are enable relatively smoother analysis of nonlinearities, correlations, and other related things. So absolutely should help in handling the more complex environment that we see. Taking a slightly different look on the data management side, something that underpins computational aspects, regardless of whether they are new techniques as in AI, etc., or relatively standard techniques of option pricing, regulatory ratio calculations, etc., etc. Gervin, I think your thesis is about, your perspective is a little more focused on the data management side of the equation. So what would be your thinking there?
Yeah, before I answer that, I will take up the joke. I'm actually more optimistic because I'm in treasury, not in risk. So from that perspective, maybe it's good because we are forecasting more or less the ratios and the future and try to find ways to address actually our funding based on our forecast. And AI is more or less maybe more analyzing the facts and using this facts or the data to solve that. Anyhow, answering your question, I'm a strong believer in modeling and analyzing actually capacity in treasury, because yeah, you have to have the capacity to do the forecast, which I just mentioned. But for that, I do need two things. One is I should be able to slice and dice the data from our customers and their behaviors to a much deeper extent than I have done before. And we do see that currently in more or less the market of our retail markets, where yeah, we have to be on daily data what's happening with our customers, because there's so much competition introduced into the German deposit market, and the market is growing, but it's not growing so fast that everybody who has re-entered can actually fulfill their ambition. So you have to be better from your analysis capacity to create the loyalty and retain actually all your clients and grow your clients you want. Therefore, yeah, you have to analyze the data much better. But for doing that, you have to get actually the people on board. And I think the mentality in treasury, or the people we have in treasury, they have changed a lot. You know, in the old days, we had actually traders, then we had actually maybe people looking more at regulation and so on, and helping the banks to introduce the new regulation into the bank. Now we did need data scientists. You know, I have actually, the last 3 hires I've done, they've all actually data background, and they can actually work with databases, and they love it. And what they have come up with in the last half year, I'm really impressed. Although I think I'm quite open to that, because I've done programming in the past as well. So, but yeah, they are more advanced, of course, than I have been. So, but this is the future, and that links very nicely then, I think, in artificial intelligence. If you have all this data and you have more or less the historic trends and so on, then you can actually maybe do something with it and predict even, and use it even for forecasting in treasury. But I'm afraid there is a long way to go in treasury before the efficiencies will lead to maybe redundancies on treasury jobs. So right now we are more on increasing actually our staff to make that happen, maybe to get the efficiencies then later on that point.
Thank you. So I think we've had a fairly you know, we've covered a fair degree of ground, including starting with the challenges of the metrics, as it were, the efficacy of the metrics, which as Cristiano suggested was significant, but there are challenges, and central banks need to think harder given the environment. And I think then we've also covered the impacts of the interest rate risk on the banking book, and then moved into looking at the roles technology plays, data science plays. How do you potentially forecast things into the future? And we're still seeing experienced professionals like Cristiano and Gerwin in the future, leveraging these tools and being challenged by the market environment, as it were, as things go forward. So with that, hopefully we've had an interesting conversation, and that has covered broad ground. And thank you both. Thank you, Cristiano. Thank you, Gerwin. And we bring this to a close today.
Thank you, Sid.
It was a pleasure.
Thank you.